fine. I'm okay with the events that are unfolding currently. That's okay. Things are gonna be okay.
Hey, have I got your attention? Good. This is James Anderson on behalf of SD Bullion, and we're going to start this week looking again at the M3 wall of currency creation, ramping at rates it's never ramped at prior. See the bottom section? It says that in year-on-year rate of change terms, the largest aggregate currency and near currency supply measure is shooting up faster than it ever has done so throughout this near 50-year full fiat currency era. Remember, dear viewers, we covered here real-time how this ongoing viral crisis bailout is only now coinciding with the ongoing New York Fed repo loan ramps that started in September 2019 and continue through today. Still no words as to which major financial institutions are bankrupt just yet. Come back later this year for perhaps some of those names. Chairman Jerome Powell is not worried about either price inflation upcoming nor his private Federal Reserve's exploding balance sheet either.
In terms of the balance sheet, and first, inflation is the inflation concerns for now are to the downside. The risks are to the downside, not to the upside. We see prices moving down. That's because in a lot of parts of the economy, people are cutting prices. So you'll see weak inflation data for a while. I would say, of course, our balance sheet can't go to infinity. I would say that I'm comfortable with where we are now and the path that we're on, and don't see risks based on what we're doing right now to inflation or to financial stability.
Unprecedented unemployment update. 40.8 million U.S. citizens have officially lost their jobs over the last 2.5 months of time. That's like 1/4 of the working population of the United States of America. You know when the last time only 60.2% were working for a living? Visit the website WTFHappenedIn1971.com to get the gist of how our full fiat financialization has led to much of the mess we're now currently facing. U.S. Treasury Secretary Steve Mnuchin held a press conference last week to publicly brag about sending 4 million of these debit cards to U.S. citizens, many of whom are part of the often forgotten unbanked class. These ATM cards arrive loaded with the 1,200 fiat Fed notes that the government bequeathed U.S. citizens via the partially inaudible CARE Act bailouts, the bailout that we covered on this channel in a video entitled Another Financial Coup by Crisis Arrives 2020 Bailout. Speaking of Burr, our friends over at the free In Gold We Trust report released their annual PDF of gold-related charts. They had the following to say about the power of memes and mockery this decade. The realization that central bank money supply will only know one direction will also affect the highest good of an uncovered fiat currency: confidence. In addition to system-critical gold bugs, an increasing number of fiat money critics can also be found within the younger generation, much of whom reach this insight by studying cryptocurrencies. As the new QE programs are rolled out, these youthful citizens of the world are taking to social media to hold the overseers of monetary policy responsible. With the implementation of the new QE programs, memes, fun homepages, and YouTube videos have appeared online in the USA around the slogan, "Money Printer Go Burr." Critics of the current monetary system are still in the minority. However, a world dominated by permanent money printing should increase the popularity of this critical view in the coming years. In addition, even more radical measures, such as the implementation of MMT, helicopter money, increased financial repression measures such as cash restrictions, and low negative interest rates, can be expected in the course of the next few years. This week, more bad news for soon-to-stop trading precious metals desk of Scotiabank, as another $168 million loss was disclosed, citing costs related to the winding down of their metals business and U.S. Department of Justice investigations ongoing. In other words, the cost of closing losing bets at a loss and turning state's evidence, handing over loads of documents pertaining to the criminal investigation of JP Morgan's precious metals trading desk continues on. Another Canadian bank had its head handed to it by gold, this time to the tune of 64 million fiat Fed note loss in one day of trading. Apparently, many bet-losing commercial banks are now reducing their positions on the COMEX. Peter Hobson of Reuters reports some bullion banks are no longer willing to hold large positions on COMEX, the biggest gold futures market, after the coronavirus snarled the supply of gold bars, sending COMEX prices vaulting above London rates in March. The divergence wiped hundreds of millions of dollars off the value of trading books, according to industry sources, with HSBC reporting a 200 million paper loss in a single day, which we reported here on this channel. Many banks have already reduced their day-to-day trading on COMEX since the market disrupted, but they are worried that prices could diverge again, and some now intend to reduce their open positions by between 50 to 75%, sources at 6 lenders said. Even with this lower participation from banks, COMEX as the largest gold futures market will likely remain dominant for the foreseeable future. There's no alternative, said an industry source. Where's the trading going to go? COMEX's daily trading volumes and notional volumes may have fallen off a cliff of late, but don't be fooled. They're only back at levels where they were last time when we left $1,800 an ounce gold in late 2012. On this channel, we recently covered the CME Group's COMEX new 400-ounce 4GC contract, which has effectively now tripled the supposed underlying gold fractionally backing this COMEX futures exchange. In doing this, the CFTC's new position limit calculation appears to allow the remaining commercial banks, like HSBC, JP Morgan, and UBS, to more than double their supposed gold futures contracts position limits. Oh, and by the way, that new 400-ounce COMEX 4GC futures contract, the market never asked for that. And how do I know this? Because the 4GC contract started about 2 months ago, and there were only 11 contracts in total volume being traded through this week. In other words, newsflash, it was implemented for a different motive. The largest gold ETFs, GLD and IEU, have had exploding demand since last year, 2019, and the same goes for the largest silver ETF called SLV. Here you can see them all three stacked on top of one another, GLD on the top, IAU in the center, SLV at the bottom. If you look at the left-hand side with the black lines, that's the demand in terms of ounces going into each respective ETF. You can see how they all rocketed up last year in 2019 and haven't stopped since. My cynical bet is that gold commercial bank traders are backing out because bullion demand is starting to blow holes through their trading desks. Have a look at this breathtaking chart. These are gold bullion imports into the USA. Notice how there is no illustration of any gold supposedly coming into the USA from London hoards, as many of these articles have been claiming. As a matter of fact, the vast swath of this gold bullion is likely coming fresh, brand new, 0.99 fine gold bullion bars, refined by some of the largest Big Four Swiss gold refineries. All this is happening while China and India's gold markets are effectively turned off for the moment. The center section of this chart that you're looking at now is simply the UK to USA gold import chart, and it goes 20 years in terms of time. Something went wrong in late 2019, and it looks like a lot of gold had to be imported into the USA from London. But through January 2020, there has been no gold bullion coming in from London, and we shall see in the coming months if that data changes. What happens to this gold market when the East returns and there's not enough physical gold bullion to go around is a question to ponder. And you guessed it. You'd better get your bullion position now before prices begin their mania, and those supplies before they run away and hide. That's it for this week. Thank you for tuning in. Take care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.